Welcome to the Deep Dive. This is our Talk Tickers segment, where we cut through the noise of earnings season.
We try to, anyway.
We try. Today we're looking at DoubleVerify, ticker DV, and their pretty dramatic Q3 2025 earnings call.
Yeah, dramatic is the word. It's this really strange situation, isn't it?
It really is. Our mission here is to unpack this, the stark difference between how the company is actually running efficiently, profitably, and how investors reacted, which was not well.
Not well at all. An immediate sell-off. It was like management walked in beaming about operational wins, AI progress, strong growth in social and CTV.
All good things.
All good things. But the market just zoomed in on two things. Revenue missed estimates by a little bit, and the Q4 outlook felt a bit cautious on growth. Whiplash, like you said.
Okay, so let's nail down those numbers that triggered the initial alarm bells. Q3 revenue came in at $188.6 million.
Right, and the expectation, the consensus, was closer to $190.2 million.
Not a huge miss in absolute terms, but symbolically important, maybe.
Yeah.
It broke that pattern of consistent beats. Still, 11% growth year over year.
True, but that slight top-line softness, it kind of flowed downwards. Adjusted EPS landed at $0.22.
Which missed the street's range, right? They were looking for more like 26 cents, 27 cents.
Exactly. So I've got the top-line miss, you've got the bottom-line miss. That's tough for any growth-oriented stock. Puts immediate pressure on.
But here's the twist. The thing that makes you scratch your head, profitability, was actually fantastic.
Phenomenal, even. Adjusted EBITDA hit $65.9 million. That's a 35% margin.
And that wasn't just in line with guidance, it beat guidance significantly.
It did. It tells you the company's operations are incredibly lean, very disciplined. They're finding leverage even when that top-line growth isn't maybe what everyone hoped for.
Strong operating cash flow, too, wasn't it? Around $51 million.
Yeah, solid cash generation. But you're right, the market just seemed to ignore it. The volume told the story. It jumped to 11.5 million shares traded.
Compared to what, like a 3.3 million average?
Right. Massive spike. It confirms everyone just slammed the sell button focused on that revenue number and the guidance, thinking we'll figure out the details later.
Speaking of guidance, that definitely poured some fuel on the fire. Q4 revenue guided to $207 million to $211 million.
Which, okay, at the midpoint, that's only about 10% year-over-year growth.
And that 10% number, well, it just landed flat, didn't it? Investors are conditioned to expect more from DV.
They are. Management did point to clear macro stuff, softer ad budgets, particularly in retail, though they did say CPG was holding up okay, which is an important offset.
Okay, but let's connect these dots because it feels contradictory. They miss on revenue, guide Q4 growth lower than hoped. Yet they raise the full year 2025 adjusted EBITDA margin guide to around 33%.
See, that's the interesting part.
How does that work? Are they just cutting costs to the bone, or is something else driving that profitability confidence?
I think it's the latter. They're leaning into what they can control, and that seems to be efficiency gains driven by AI. They spent a lot of time on the call talking about this.
Right, the AI-led efficiency. And some of the numbers they threw out were kind of staggering.
Absolutely staggering. They mentioned this internal metric, their new agentic classification system. It can scale their content labeling volume by 260%.
Okay, huge increase in volume handling.
And wait for it, generate the results 2,300 times faster than a human doing the same labeling.
2,300 times.
Yeah. That's not just, a little bit better. That's a fundamental shift in productivity.
Okay, so that explains the confidence in the margin. It's structural, based on technology, not just temporary belt-tightening.
Exactly. And they're using that AI power not just for internal efficiency, but to launch new products, too. The DV AI verification suite, agent ID measurement, and the memorable one.
The AI SlopStopper. You gotta love the name. Is it just clever marketing, or is there a real substance behind it?
Well, probably a bit of both, but the core idea is crucial, right? As AI starts generating more content and even running campaigns, who verifies it? Who ensures it's safe, suitable, actually seen?
There's a trust gap.
A massive trust gap. DV is positioning itself as the essential independent checker in this new AI era, verifying human and AI engagement.
That makes sense. And that verification need seems to be the driving force behind their big strategic pushes into social and CTV. Let's talk social first. Seems like there's real momentum there.
Definitely. DV Authentic Advantage, the new tool they launched on YouTube. Really strong start. They signed up about $8 million in annual contract value, ACV, in just the first few weeks.
Wow. Okay. That's quick uptake.
Shows advertisers see the need immediately. And they have performance data, too. Early tests, mostly with CPG brands, showed it delivered 24% to 34% lower CPMs.
While keeping brand suitability high, that's a solid pitch. Lower cost, same or better safety.
Yep. And their meta pre-bid solution is also apparently ramping faster than they expected. 56 advertisers live now.
What's really interesting, though, is how AI itself seems to be increasing the need for DV. They found something about suitability rates in AI-run campaigns.
Yeah, this was fascinating. They said in their sample, brand suitability was about 2 points lower on average in AI-run social campaigns compared to standard ones.
So the AI optimization might be efficient, but maybe a little too aggressive, less discerning.
Could be. Whatever the reason, it proves DV's value proposition. Advertisers see this risk.
And they react how?
They apply DV's pre-bid protection 3 times as often on those AI campaigns compared to standard ones. 3 times.
Okay, so as the platforms get more complex, more black box with their AI, advertisers actually rely more on third-party verification like DV for safety and transparency.
That's the key insight. It's becoming less of a nice-to-have and more of a must-have safety layer.
Right, let's shift gears to CTV. Connected TV, still a huge area for them. Measurement volumes up 30% year over year. Good momentum.
Solid growth. But they highlighted a really specific, costly problem here.
The waste factor.
Exactly. They estimate that around 15% of what advertisers think are CTV impressions are actually being served in totally different environments, like mobile game apps showing on a TV screen, but not true CTV.
15%? That sounds like a lot.
It is. They put a number on it, potentially costing the industry over $1 billion every quarter.
Billion a quarter.
Yeah.
Okay, that's a powerful problem to solve. Is that the big differentiator for them? Highlighting that quantifiable waste.
I think it gives them a really strong sales angle, yeah. When the potential waste is that big, advertisers are definitely willing to pay to avoid it.
And their solution is the verified streaming TV measurement and these new pre-bid segments. Basically, tools to ensure ads only run in genuine, high-quality TV environments.
That's the goal. Plus, they just launched a partnership with IMDb.
Oh, interesting. For what?
Show-level transparency. So brands can ensure suitability not just at the channel level, but down to the specific program. That feels like a necessary upgrade for CTV measurement.
Okay, so you've got these powerful AI efficiency engines driving margin and these new high-value products tackling major issues in social and CTV. Let's tie it back to the financials that the market seemed to ignore.
Right, the balance sheet. Over $200 million in cash. 0 long-term debt. That gives them enormous flexibility.
Which they're using, right. They've been buying back stock.
Actively. In Q3, they bought back 3.3 million shares. Spent about $50.1 million doing it.
And crucially, they still had authorization left at the time of the call.
Yeah. $90 million remaining authorized for more buybacks as of early November.
That financial strength, that cash generation, no debt. It feels like a real competitive advantage, especially if competitors are maybe more leveraged or distracted, say, by going private.
Absolutely. Management made a point of saying they've invested $210 million more in GAPE R&D than their closest competitor just since the start of 2023 through Q3 25. They have the resources to keep innovating.
And they have a long-term vision for where this innovation is taking them. They talk about a medium-term goal.
Their North Star, yeah. They want to grow the revenue contribution from those 3 key pillars: social, streaming TV, and the AI verification stuff from under 30% today
to around 50% of total revenue.
That's the goal. A pretty significant strategic shift over the next few years.
Which seems necessary, maybe, given their baseline outlook for growth. They mentioned a base case for 2026 revenue growth.
Yeah, and it was cautious, around 10%, basically continuing the kind of growth rate they guided for Q4 25.
10% base case for 26.
Yeah.
After hearing about AI SlopStoppers and billion-dollar CTV waste, it feels a little underwhelming. Are they just being conservative, you think? Sandbagging?
Could be prudence. They were very clear.
Yeah.
Any growth above that 10% base case depends entirely on how quickly customers adopt these new social and CTV products.
They know their big enterprise clients can take time to roll things out.
Exactly. But what underpins it all, and this is important, is customer stability. Gross revenue retention is still over 95%.
And no churn among their top 100 customers.
0 churn. So the growth story isn't about replacing lost clients. It's all about upselling, cross-selling these new solutions into that very stable existing base.
The foundation's solid. It's just a question of how fast they can build the next floor.
Well put, low-risk customer base, but adoption speed is the variable.
Okay, let's move into our final segment, and we have to stress this really clearly. This is not financial advice. Seriously, this is purely us exploring a hypothetical trade idea based on the call and that extreme market reaction.
Absolutely, just a thought experiment. But the setup is compelling, right? The stock cratered, hit a new 52-week low intraday, down around $7.64 at one point.
Which feels pretty disconnected from a company beating on margin and raising its full-year profitability outlook.
Totally disconnected. So the aggressive contrarian idea hinges on that disconnect and the company's own actions.
Meaning the buyback.
Exactly. The idea is to bet aggressively that management sees this massive share price drop as an opportunity and immediately starts deploying that remaining $90 million buyback authorization near these lows.
Why aggressive? Why not just buy the stock if you think it's cheap?
Leverage. The $90 million is actually pretty significant relative to the market cap after that big drop. So instead of just buying shares, the idea would be something like buying long-dated, deep-in-the-money call options.
Okay, using options for leverage.
Right. You're leveraging two things. One, the proven operational strength, that raised margin guide. Two, the potential near-term floor provided by that $90 million buyback cannon waiting to be fired. It's a bet that those factors overwhelm the short-term noise about retail softness.
So pitting the fundamentals, strong operations, smart capital allocation against the market's current fear about near-term growth.
It's essentially betting that management acts rationally and aggressively, takes advantage of what they likely perceive as a gift from the market at those 7-8 levels.
All right, so our final provocative thought for you, the listener, to chew on. Given everything we've discussed, the new solutions like Authentic Advantage, verified streaming TV, the whole AI suite, if these tools capture even, say, half of the long-term revenue opportunity DV thinks they have,
does this current, maybe temporary growth slowdown even matter in the grand scheme of things?
or is the market completely missing the plot on a major platform expansion that could play out over several years?
It really boils down to your time horizon, doesn't it? Are you focused on the next quarter's revenue or the potential for much higher margins and a larger addressable market down the road? Where you stand on that likely shapes how you view DV's valuation right now.
Lots to think about. Remember, everything discussed here is purely for informational purposes. Always do your own research. Thanks for joining us for this deep dive.
We'll catch you on the next one.